The most catastrophic institutional betrayal in the history of cryptocurrency occurred in the finance sector. The biggest single asset was just executed by Blackrock, the $10 trillion asset management behemoth that has previously pledged transformative blockchain use. The synchronized sales of their entire $100 billion Shiba Inu holdings caused widespread fear in the cryptocurrency world, and they dumped all of their digital assets. Institutional trading desks began to identify huge sell orders flooding key exchanges simultaneously at 340. Algorithmic distribution design allowed BlackRock's institutional wallets to systematically dump their entire SIB stake across Binance, Coinbase, and OKX, at the expense of short-term pricing stability in order to optimize liquidity extraction. However, the covert strategy was a resounding failure. Within minutes of the coordinated dump pattern being detected at 4:15 a.m., automated notifications were sent out to more than 2.3 million cryptocurrency holders. There was instant and devastating psychological harm. Retail investors started dumping their stocks in a panic before the extent of the betrayal was fully understood. They had relied on BlackRock's institutional validation. No amount of technical research could have foretold the methodical devastation revealed by the statistics. The $100 billion stake held by BlackRock accounted for over 13% of Shiba Inu's overall market valuation. The mathematical pressure eventually broke through all months-long support levels as institutional algorithms started selling off this huge allocation. Within 6 hours, the price lost $2.7 billion in market value as it fell from 40136 to 4089, a 34% decrease. Exchange data shows that BlackRock's withdrawal strategy was well coordinated. Their institutional trading systems placed more than 47,000 distinct sell orders across various platforms, all of which were smaller than the size requirements that normally elicit whale alert messages. This strategy avoided a single large transaction that would have caused noticeable market disruption. This psychological battle was well planned and executed. When American retail activity normally hits daily lows around Asian trading hours, BlackRock started to pull out. Their own transaction costs were minimized while the influence on price discovery was increased due to this time. It was too late to turn back the clock when European markets opened. There was a verge on total submission from the community, as holders who had put their faith in institutional validation came to terms with the fact that they had been consistently misled. Narratives of betrayal began to flood social media. There was selling pressure that went much beyond BlackRock's actual liquidation volumes because to the psychological change from retail abandonment to institutional confidence. As institutional selling pressure caused conventional support levels to fall, technical analysis lost all of its meaning. Within hours, the 200-day moving average, which had supported the market during earlier corrections, was broken. In the midst of the unrelenting decline, Fibonacci retracement levels that often offered bounce chances instead became brief pauses. However, this betrayal is especially tragic because of this. In its public pronouncements, BlackRock has always stressed its dedication to the growth of Bitcoin ecosystems and innovations over the long term. In a bullish analysis, their research teams have highlighted Shiba Inu's evolution from a meme token to a utility infrastructure. Their departure from the university ran counter to all of their stated public positions. Anonymous BlackRock workers have disclosed internal documents that show how their allocation approach is based on purposeful deceit. The $100 billion Shib stake was never meant to be an investment in the ecosystem, but rather a play to extract liquidity for the near term, according to executive communications. Instead than seeing retail investor trust as valuable, senior management saw it as exploitable. The meme coin industry as a whole became infected, not just individual Shib owners. In a supportive selling environment, investors dumped Dogecoin, Peppa, and other new coins, doubted the reliability of any community-driven initiative that received funding from institutions. Institutional cryptocurrency adoption as a whole lost credibility, and that hurt for good. Automated stop-loss executions set off a chain reaction of liquidation events, and algorithmic trading tools made the devastation much worse. Automatically closing thousands of retail holdings at worst-case levels occurred as price momentum turned sharply negative, bolstering the artificially inflated sales pressures created by BlackRock's algorithms. A systematic flight of capital is revealed by the narrative of exchange reserves. Within 12 hours, holders scrambled to safeguard their remaining holdings in secret wallets, causing Coinbase to record $1.2 billion in net Shiba outflows. As market makers lowered their support for the bid-ask spread, the liquidity drain exacerbated price pressure. Institutional Bitcoin involvement may be irrevocably altered by regulatory consequences. The timing of BlackRock's departure and its public communication techniques are already the subject of probes demanded by congressional lawmakers. To determine if institutional position management amounts to market manipulation, The SEC has initiated preliminary investigations. No haven from the methodical devastation could be found in international markets. It was confirmed that BlackRock's liquidation strategy was global, not limited to American trading platforms, as the selling pressure patterns on European and Asian exchanges were identical. Within hours, retail investors started suing BlackRock, claiming that the investment firm's public positive pronouncements were an attempt at fraudulent enticement, even as the firm secretly prepared a systematic liquidation. The damages that could be awarded could surpass $500 million, according to the preliminary class action filings. It is ironic that the crisis coincided with the acceleration of the ecosystem development schedule that had initially piqued BlackRock's interest. News of new partnerships. Fundamental progress is not dependent on speculative capital flows, as seen by the persistence of governance implementations and utility expansions in the face of institutional betrayal. Institutional manipulation followed typical patterns, as long-term holders who had weathered past market cycles could see.